How to defer capital gains on a land contract. Greetings, property owners. Welcome to another segment here on my channel. So you think about selling your property on the land contract, and you want to understand how to defer your capital gains on an installment sale. Well, stick around and we'll dive right into that. Now, I try to simplify exactly how that works. My name is Josh. I'm a property investor here in Madison, Wisconsin. My company has been established since 2017. We buy and sell property on installments. So I like to think buying and sell property on land contracts are our specialty. One of the things, one of the reasons why we like to use that strategy to buy and sell property is because we get to defer our capital gains on our sales. So one of you start, to even begin the process of deferring your capital gains, you start with the IRS form 6252, the installment sales income form. This form has two different methods of accounting. One is the cost method, and the other is the installment method. And I'll go over both of those real quick. So, the concept and the whole strategy is called above the line accounting. So above the line accounting, the whole idea of above the line accounting is to adjust your gross income with expenses, which means the more income you make, the more you want to put into your expenses, which will help you lower your income. So the more you put into expenses, the further down your income drop through the tax bracket, the less your tax liability becomes. Additionally, what happens is the further down your income goes in the tax bracket, your deductions begin to increase. This is why most W-2 earners receive a refund, is because their earnings is within a tax bracket that gives them maximum deductions. So the whole, like I say, the concept is above the line accounting, adjust your income with expenses. So this is how deferring your capital gains work with an installment sale of a land contract. Your land contract you put up for sale for $1.5 million. Your basis is $500,000. This is what you went into the property with, is $500,000. So that's your basis. This you'll get back. You could get untaxed with up to $500,000 if you're married on the first year of on the first year sale of a property. So that's the 2-year rule. If you lived in a property between 2 to 5 years, you could get your $500,000 on sale of the property untaxed. So that's the basis though. And additionally, that's if you lived in the property. If you have not lived in the property, you can use the excess business loss limitation rule, which allows you to use business expenses to offset your gross income still. So your basis is $500,000. You went into that property with $500,000, and your profit is $1 million. Okay. So if you're single and you want to receive this $500,000, your tax let's see here. Your tax allowance would be $250,000. So if you're single and you want to receive your money from your sale untaxed, you would have to at least receive that $500,000 over 2 years. So you could receive that money untaxed, because your yearly taxable allowance as a single person is $250,000. $500,000 if you're married. So with that in mind, if you are a single person and you can only receive up to $250,000 a year, then you would take that $1 million profit and save it from this 25% capital gains, which would happen if you realize your sale of the profit of your sale that year. So if you take your profit of your sale that year, you will be taxed $250,000 on your sale. If you want to save yourself $250,000, defer that over several years at your maximum taxable allowance, which is, if you're single, $250,000, and you defer that, or you receive your installment over years. And so that's how you escape capital gains, by receiving your income, your maximum taxable income, or your maximum taxable allowance for whatever your situation is. If you're single or if you're married, it all matters. $500,000 if you're married, $250,000 if you're single. Receive your income up to your maximum taxable allowance over the years, and you will save yourself that capital gain. Now, what happens is if you receive income that's over that $250,000, you want to turn that extra income into expenses. So, this will happen with a lot of high net worth individuals. Their accounting will tell them, hey, it's time to go out and spend some money because you're making too much money. The accountant would say, hey, you're getting to the line, you got to spend some money. So they'll go out there and they'll invest into property and, things like that. And they'll take their income and drop their income. Wealthy individuals been doing this for quite some time, and now it's time for, the investing public to, understand how the strategy worked to their benefit too. So that's just that's just the benefit of, or that's just the installment sale method right there. So adjust your gross income by receiving your income over years and up to your maximum allowable uh, uh, income. Now, the other method is the cost of sales method. The cost of sales method is real simple. The cost of sale method is if you have a mortgage on the property when you sell it on the land contract, and you do not want to realize the income that you're making until you pay off that mortgage. So say you had $500,000 on a mortgage or left on your mortgage, you can use the cost of sale method to say, hey, I'm receiving this money, but I'm not realizing it because it's going out to be paid for, for a debt. So that $500,000 you receive will not count towards your credits, your tax credit, or your profits. So you'll receive that income and then to pay off your debts. Then after you receive your debts, and everything else after that will be considered, your ordinary income, or income off of your profits over the years. So then you could do the installment sale method after that. But the cost of sale method is pretty simple. It's just to say, hey, I'm paying off a debt before I realize my income. So you pay off the debt first and then you realize your income. Same thing applies when you receive any extra income here. After you pay off your debt, you want to offset your expenses. Additionally, here when you have a debt, you can still receive more income, but the income that you receive here, this is the only thing that you'll pay taxes on. So whatever income you receive on the cost of sales method, so if that's $20,000, you'd only pay taxes on that $20,000 income when you spent $250,000 paying off your mortgage. So that's another great strategy. So I hope I made this simple for you. Defer your capital gains by taking advantage or taking control of your equity. Putting the seller in the driver's seat is what I want to see and what I like to do here. Either way, stick around. Maybe we'll talk a little more. You can dive into another video. Click on the link. Subscribe even. Give me a call. I'll leave my email, phone number below here, and I'll be more than happy to discuss this strategy with you.